I'd like to introduce Ben Su, our next speaker. He's the co-founder and COO of Capita, who will be talking about the future of no-code investment DAOs and digital securities. Over to you, Ben.
Hello, everyone. Very pleased to present to you today on the topic that I feel extremely passionate about: the future of no-code investment DAOs and digital securities. I will be discussing the content related to governance, compliance, and the next iteration of institutional investing. Nothing mentioned in this presentation is intended to be relied on as legal or financial advice. Please consult your own lawyer and financial advisors. So here's a brief introduction about myself. I am a co-founder of Capita, a venture-backed company building the smart contract operating system for investment funds, syndicates, and DAOs. I am also a licensed corporate lawyer in the province of Ontario, Canada. I previously served as a committee member to the Legal Futures Initiative at the Canadian Bar Association. My team and I are helping institutional customers building investment funds using the latest blockchain smart contract technology. First, I would like to take everyone down the memory lane by looking at the history of the investment industry. So as humans, we have always attempted to improve societal productivity output by committing resources together from a good harvest year into development projects that could scale productivity later. Investment is basically the deployment of resources, for example, capital, with the expectation to achieve later benefits. People/investors who had savings may have the desire to amplify their wealth by investing in other people. For example, founders of a startup who have the means to scale productivity outputs. However, the simple concept created a series of complex problems. How does the system protect the rights and expectations of the investors? How do you make the system efficient enough to encourage entrepreneurs and investors to work together and scale productivity? It is, in my opinion, that the first systemic investment industry recorded ever in the history of human civilization was born in the ancient Babylon under the ruling of the king Hammurabi. The famous Hammurabi Code, the first ever piece of investment legislation written in text, established a means for the pledge of collateral by codifying debtor and creditor rights in regard to pledged land. It also provided deterrence mechanisms for breaking financial obligations. Now, fast forward to the 1600s, the Amsterdam Stock Exchange, which opened in 1602. This is often named as the first stock market. Despite opening over 400 years ago, the basics of the Amsterdam Stock Exchange in the 1600s work the same as stock market today, connecting potential investors with investment opportunities and businesses with investors for capital injection. It was originally set up by the Dutch East India Company to issue shares. Now, fast forward to the 1930s and 1940s. The next major milestones for shaping the modern investment industry, as we know, was the Securities Act, which was signed into law by President Roosevelt in 1933. This piece of legislation paved the foundation for establishing a fair and efficient capital market. Later on, the landmark court case, the United States Securities Exchange Commission versus W.J. Howey, gave us the famous Howey test. The Supreme Court of the United States provided a four-pronged legal test to classify whether a transaction or an investment contract involves security, and therefore subject to the jurisdiction of the Securities Act. Such transactions involve 1. A person invests his money, 2. in a common enterprise, and 3. is led to expect profits, and 4. significantly relying on the efforts of others. The Howey test is still the governing legal principle with a vital importance in the crypto space. At the time of this recording, I know everyone in the Web3 space is anxiously waiting for the decision on SEC versus Ripple, which would determine whether the sale of XRP tokens constituted an unregistered security offering to investors. The outcome of the US regulators' court case against Ripple will have a far-reaching consequences for the cryptocurrency industry. Fast forward again to the post-World War II era. The financial industry underwent several transformational changes. With the rise of Wall Street, we're seeing more and more complexity in investment transactions. Some examples include mortgage-backed securities, the MBS, collateralized debt obligations, CDOs, and credit default swaps, etc. These changes are nothing but financial and legal trickeries. The only technological innovation was the invention of spreadsheets. Many fintech products we use today are nothing more than glorified Excel spreadsheets. For example, Carta. Fast forward to the 2022-2023 era. Financial services became one of America's top industries. I would like to steal a Warren Buffett quote. Only when the tide goes out do you discover who's been swimming naked. In the recent macro environment, we're beginning to see who have been swimming naked, starting with Archegos, 3AC Capital, Celsius, and the infamous FTX Alameda, as well as the recent Silicon Valley Bank and Credit Suisse liquidity crises. In the crypto industry alone, it was reported that $44 billion were lost in the year of 2022 due to human failures in governance that we're seeing here. At the root of all these financial tragedies, what we're seeing is a great power and knowledge imbalance between investors and few people that dictate the direction of the industry at large. This is the classic example that we're facing as the investment industry. Now, it is my opinion that opacity needs to power imbalance, which then turns into exploitation. If this problem is not solved, history will repeat itself over and over again, just in different forms. How do we as an industry address the exploitation problem? Do we make people more ethical? Or do we enact more regulations and deterrence mechanisms, adding more red tapes to the industry that is already known as the most heavily regulated industry? Well, good luck with that. Can we force everyone to act in a more ethical way? Or can we inform everyone of the risks of immoral actions? I believe blockchain as a technology can help achieve these two goals. In the previous financial crisis, we witnessed the birth of Bitcoin as humans answer to irresponsible monetary policies. And it is my belief that the current macro downturn will empower investors and capital markets to demand more transparency and immutable smart contract governance, which in a counterintuitive way, not only going to improve fairness and investor protection, but also capital markets efficiency by removing the risk uncertainties and the middlemen toe takers. And this is the theme of my presentation. I would like to show everyone some of the behind-the-scene works of those who are building the future of no-code investment DAOs and digital securities. Now let's get down to business and talk about DAOs. We are already seeing the rise of decentralized autonomous organizations, also known as DAOs. Uniswap and Maker are the two great examples of DAOs succeeding in forming and governing the allocation of capital. Uniswap is a decentralized crypto exchange built on Ethereum. It has over $1.3 trillion in trading volume and 136 million all-time trades. MakerDAO, on the other hand, governs the Maker protocol, which issues a US dollar pegged stablecoin called DAI token. These DAOs all have built-in blockchain-powered governance. Token holders are empowered to participate in the governance and decision-making process of the organization. It is worth noting that I'm not endorsing any of these tokens, so please do not rely on anything I'm saying as legal or investment advice. Now, it is important to note that most of the DAOs we're seeing popping up today have tokens that are only functioning as a record of ownership, absent of any meaningful automated enforcement of governance rights. This creates exploitation risks. Token holders often are asked to submit their vote in a polling website that is not on the blockchain. In many instances, votes of the token holders were not actually executed as transactions on the blockchain layer. So as a lawyer, I can tell you these contractual rights for the token holders, if not executed on the blockchain layer, they're equivalent to contracts in the real world that is not legally enforceable. So it's just wasting time and disappointing the expectation of the token holders. What this does is that it leads to the current state of crypto securities in 2023. We have central actors in a falsely decentralized world without fair negotiated contracts and no enforcement mechanisms. Many crypto projects are skirting the regulatory framework by trying to defeat the Howey test. So what may end up happening is people use crypto or Web3 to scam other people, take their money and walk away. So it is my opinion that in order for investment DAOs and digital securities to become mainstream and for the institutional capital markets to adopt such technology, we need to do two things. Number one, we need to play within the regulatory framework of securities law. What that means is that smart contracts of the DAOs that are operating, they need to be default compliant to securities law. These smart contracts need to have built-in compliance strategy that are dictating the securities transactions. For example, token transfer restrictions and lockup periods in certain securities issuance. Secondly, I think it is important to make DAOs truly autonomous with transparent and immutable self-executing governance smart contracts. This is the only way to prevent human failures or malicious rug pulls that are hurting investors, which we're seeing today. Next, I would like to clear up some misunderstandings on DAOs and crypto securities. On the regulatory compliance front, I would like to mention that as a lawyer, I am naturally biased in saying this. I think securities law is clear for those who are willing to read it. First of all, if you look at the Howey test, is there investment of money in a common enterprise with expectation of profit, significantly relying on the efforts of the promoter or a third party? If you're checking all these boxes, you are a security. Doesn't matter what you do, what you argue. The court is going to apply the same Howey test that the Supreme Court came up with in 1946. So in order to be adopted by the mainstream institution capital, like I was saying earlier, participants in Web3 finance and DAOs must play fair within the framework of securities law. These laws are created for a reason, and that is to protect investors, protecting the fairness and efficiency of the capital markets. I would like to clear up the misunderstanding that in DAO governance, decentralization does not mean one person, one vote democracy. Why this is an important misunderstanding to clear up is that I often hear critics of DAOs saying investment industry requires a high degree of expertise in order to exercise judgment on capital allocation decisions. However, just like how corporations are organized, you have shareholders electing those who are competent to act as directors of the board, and the directors of the board appointing those who are competent in executing the daily operations of the company. In DAOs, representative democracy can also work. For example, here's a screenshot of the latest Capita smart contract on governance. What you're seeing here is that the token holder of a DAO can delegate their governance tokens to a person that they deem to be competent in making certain capital allocation decisions. And we could do all of this as a transaction on the blockchain layer so that it is actually immutable and transparent. So this is it. I think the future is almost here. What you're seeing here are the three examples I would like to talk to you about. Number one, Kraus House is a DAO backed by some venture capital investors who are raising capital to purchase stakes in NBA teams and so on. And in the middle, Fund North is a DAO that is incubated within the University of Toronto to invest in University of Toronto-based startups and R&D projects. is acting as a venture capital investment DAO. Capita is working with all these players that you're seeing on the screen. The RV DAO, it is an investment DAO that has raised capital to purchase RVs to generate rental income. It's a very interesting underlying asset generating very interesting return profiles for investors. And again, this is how these DAOs are executing capital allocation decisions. It could be delegation of tokens with a complex voting mechanism, taking into consideration of quorum, approval threshold, and so on. So anything as a lawyer who can put into a shareholder agreement or a limited partnership agreement of a venture capital fund, we can translate those agreements and contractual obligations and rights into smart contracts. Folks, this is it. I think the future is here, and I'm very excited to witness what investment DAOs and digital securities can become in the next 5 years.